up at early in the morning, and then it's totally fine. Then I wake, then it's 10:45, and I'm in a total panic. Welcome to Jae's Corner, everybody. Sunday, 11 a.m. Eastern, the 29th. Happy New Year to everyone in advance. So we'll get right to it here. That we took a look at 2025, and for me, the latest edition of the newsletter Jae's Corner, jo.substack.com, tells you basically where we're going. And what I'm basically saying here is that most of the problems that you see can be avoided. Most money mistakes are avoidable. I'm convinced of that. Please subscribe to the Substack and to this channel. I will be on YouTube far more, against my better wishes, but this is YouTube's world. I'm just living in it. The point here is that what not to do is not to let costs run away, right? Every time I look, while I understand that most of the, and this is much better, that most of the attention goes onto the top line. How much money am I going to make? What's the revenue? You hear stock analysts, what are the revenues? What are the revenues? For me, this is still about net income. In other words, what usable money do we have? The newsletter, all the little minutia about different aspects of financial contracts, has to do ultimately with that. Getting the most means also pushing down the price. So with that in mind, we start. Here's where we're going. So first of all is down in the text below today's video, what you have is this tax guide, which I've a link to a tax guide, which is here. So this becomes, of course, a very, very important aspect of the way that we consider things for financial reasons, for many different reasons. This is the way that we're taxed in 2025. That looks to be intact at the minimum here with President-elect coming in January. So you have it here, which gives you a very good guide about the way the income taxes are, and importantly, capital gains, because with financial market movements, we're going to have capital gains, and a lot of time is used in tax efficient investing, something that I would highly encourage people to understand. Meaning that you can see it here, that the long-term capital gains tax for persons in particular areas can be all the way down to zero. Something that people should be taking advantage of compared to the 10%. So now you can understand what I'm saying is that somebody makes a mistake by a day, and in fact gets taxed at 10% instead of zero, obviously quite a lot. This is the reason that tax efficient investing is a thing. Notably, it should be. Why? Because again, how much does it cost? Right? And for that reason, that's why I included the tax matter here. So plowing straight ahead here, what we're going to do, and you'll see that the deductions here, as well as the timing of the way that you can contribute to IRAs, including catch-up amounts for people who are 50 years or older. In 2025, you can see more catch-up, which is new for into simple IRA, into simple 401ks, for example. And you can see it here. You can see additional amounts for those people who are rapidly approaching Medicare eligibility. So now you've got it. Feel free to have it. You can download it from that link. No problem. Okay. With that in mind, we do need to talk about some current events, which are fairly notable here and new items coming up all the time with the fair amount of national, wildfires, hurricanes in Florida. You can see the problem here, something that hasn't having to do with what things cost. Again, a lot of the way that I think about financial matters is, okay, we want to buy security. We want to, buy this or buy that or have the newest mobile phone. I get all that. I'm addicted to YouTube TV as they've increased their prices pretty much what seems like every 6 months. And now it's more expensive than cable. But you see Wall Street Journal here saying, that insurance and taxes now cost more than mortgages for many. And this is a fairly alarming thing because now the question of buying or renting now comes into question. So for those people trying to downsize, for example, as you transition to if you are approaching retirement, now you can see an entirely different equation has now started to present itself. And it's not a loan, right? It's not a loan, which is that I want to say that Bloomberg will have the similar type of thing. Let's just see here. Yeah, that this guy here is, yes, the hidden crisis in that because of the fact that homeowners insurance and many of the carriers have left. They've entirely left. Right? In California, you can see it here. National companies, State Farm, Allstate, Hartford. They no longer offer homeowners insurance in California, in certain areas of California. It's 11 million, and you can see the text here. So it has the inevitable result. And what it's done is they're saying, okay, the states being the insurers of last resort, which creates a whole different set of public finance questions down the road. And you can see it here, that homeowners in many are now likely to cover state last resort insurance programs where the private market won't. And so now the ripple effect goes down to the state in which you live, which creates a whole another set of problems, as I stated. That said, tax is largely in your favor, which is why I do encourage people to have a very good handle on this, so they can understand where, and you can see here, and by that same token, you will also see that over here is telling you kind of like for me, the key information, this here. Because what it's telling you is that the tax bracket is bumped, but it's only bumped for the next extra dollar. It's not bumped for the entirety, right? So in other words, down over here, you have the 24% tax bracket. That's true. But that's on the money that is made after the $206,000. So the reality is that per dollar amount, right, is not as great, to be candid. And when you think about actual dollar amounts, right, the rates may look different. That's true. But when you think about the extra dollar amounts, you will see and then understand what I'm talking about and why I start here with knowing about healthcare cost and its planning importance to people. Because now you can see over here, let's go, this is the spread, this workbook, and I was trying to arrange it for us here today, right? And you'll see it here. So this is the normal exercise that I'm running for people when I deal with their financial plan, their financial setup, to give them an idea about the way that I see that their financial setup exists, and to give you an idea on what that looks like. And I will stop here for the plug, which I'm very terrible and reluctant to do, but I should, because people ask. And the point is here, right, is that you could have, for example, life insurance, annuity, whatever it would be, whatever strategy can be your healthcare cost planning element, and just be the one-time analysis. But what ends up happening is the ripple effect, usually to the most valuable to the observant, becomes that, actually this has interactions across all of these rows. So the point here, when I'm starting here on how much does it cost, right, has to do with the fact that this stuff in red here, I'm trying to minimize, that I can't do, right? In other words, I encourage people to look, $90 a bottle of wine, maybe we turn it down to $60 a bottle of wine if you must, right? So now you have here in order to, and one of those very importantly is interest expense. The multi-layered reasons of the slogan stocks for show, bonds for dough, which is interest rates are the cost of money, right? And we're going to get to it later. You can see it here. The cost of money, Mr. Market has told you that the cost of money is higher. That means the value of cash is greater. Because every day you have a credit card balance, every day you have an outstanding debt balance, which is not your mortgage, can be compared to, okay, I can get 4.63% here risk-free versus minus 20% and higher than that on credit cards. So now your rate is not only 20%. It's actually 20% plus there's the opportunity cost. So as a result, my point here, my message, and it does not matter what your age is. So you can tell your Gen Z, millennial, running credit card debt is very expensive not because of the fact that you pay the credit card debt, as well as if you're just sitting in a money market mutual fund, you get 4.25% area. So both sides compound. So if you let this sit in a coffee can for 2 years, what you have are enormous differences in results. So it's again focused on cost here. The point ultimately being for people that it's net income. Net income. And don't get me wrong, it's easy to gloss over this. In fact, during the Alliance for Lifetime Income annual summit, right, I had to chime in at some point and raise my hand, comment there with the CEOs of companies and people from think tanks and government agencies there saying, can I change this phrase that we're using, the outcome, that the net income, meaning the annuity income being the outcome? I'm saying, can I change this to we are trying to help the net income? And now you can understand why I'm focused on healthcare cost planning and to shed light on how insurance actually works, because I'm trying to push down the cost for the benefit, which is, of course, not of course, but it is the reason that I'm sitting with this diagram that I pointed here. Every single topic, no exception, is I'm trying to minimize the loss here to get the most of profit. And by profit, that means net income. Whatever you want to call it, doesn't matter. Plus side for you, right? Which is however we get there. I didn't say, and that's why you'll also say, okay, well, I didn't say don't eat, right? I didn't say be insurance poor. I don't say that. But for certain people, having this line, having that angle is so important, given what? For health insurance, your specific health situation. It entirely changes the cost structure, and then the ripple effect should be clear to most, and certainly to followers, that it changes the most important, your total net worth. That's fine. You got to pay raise because inflation is higher. You have bad health, etc., and you've underestimated how insurance works. You've not understood how insurance works. You've given it straight back in multiples, hurting your total net worth. That also means the flip side. If you're Mr. Perfect and you are overpaying, I didn't say overpay for insurance. Didn't. I won't. Right? In fact, that's why I tell people about Medicare Advantage. It can be totally rational for Mr. Perfect with 35 children living in a shoe, living on Social Security loan to pay for $0 Medicare Advantage. Completely rational. Completely rational. This is why the never Medicare Advantage or never this, never that is just not found here on the channel. Okay. Let's go to early 2025. There are some very important good things which people can and should do in order to pursue this lower overall cost. So people don't know that the flexibility inside of health insurance in the US is in the consumer's favor. It's the point that I'm making here. That it may not seem like it's in your favor. It is, right? What you do is you put yourself in the seller's shoes, right? There is a concept called adverse selection, which is the person on the other side is doing the rational thing. So what does Mr. Sick-A-Lot do? Mr. Sick-A-Lot buys very robust insurance. Why? Because they know that once we hit the out-of-pocket maximum, the carrier pays for the balance. And your bill or Mr. Sick-A-Lot's bill is zero. So it is entirely reasonable, rational, thought through to buy the insurance where the premiums plus out-of-pocket maximum is the least, whatever that is. And you shouldn't presume that's gold, by the way. That's an entirely different video. But my point here is that under the ACA, what we can do, what we can notably say, is that we should absolutely. We're not going to resolve United Healthcare, okay? And to talk about 15 minutes, Luigi, I don't remember his last name now, even. Right, which is that the key thing for you is that the network. Who's in the network? I'd love to tell you that your healthcare providers know. They don't all know. And especially if you live in a big city where it's very fragmented. Atlanta, perfect example, right? Incredibly fragmented. And so many plans, so many different providers. I didn't say poor quality providers, I just said so many. That what you end up having is not even the healthcare providers themselves are fully clear on what plans they take. That's a problem. Under the ACA, the reality is the enrollment period here is wider than you may think. Meaning that today I've got a particular plan. Let's say, for example, on January 5th, I go to the doctor, find these out of network. Can I switch the plan? The answer to that is yes. You're going to have to check your state. The answer is yes. It's going to make sense to do so. Why? Because again, we're back to here. Your plan may have increased in premium, for example. That could have absolutely happened. Where if your plan has increased in premium without you knowing it because you were asleep at the wheel, that the best way to increase your profit is to lower the premium. And you're Mr. Perfect? Sure. All of those things, they can be adjusted. And again, back to this, how much does it cost? This difference here is just much, much bigger than all of the time and effort that we are using to, to look at this, at taxes. Let's just go back here. Looks like I've lost it. I have lost it. The tax table that I showed you, which is 22 and 24%, that is like rounding error here. If you take a look, and it's going to take a couple moments, so I'm going to run through here real quickly here. No, let's just go here. This is Chicagoland. If you've gotten this wrong, and for example, you've estimated wrong here, and you're $50,000, 45-year-old, you've made this. But if you've done this wrongly, to give you an idea, we'll just go here real quick and we'll skip this. Chicago is pretty bad just because of how big it is. But let's just go see your plans. You can see the difference here runs for, first of all, there's 100 plans. 100. And the difference here is from $200, right? So first of all, right out of the gate, someone said, okay, I make too much money. You didn't know that for sure. You didn't know if $50,000 qualified you or not. It's higher than people believe due to the Inflation Reduction Act, which is going to be on the block maybe at the end of this year. But for this year, still good, meaning that you can see it 167 times 12. To someone at $50,000, what are we doing here? Right? 160. Oh, well, I make enough money. Okay, that's true. That congratulations to you. You've now given yourself a 4% pay cut. More than. Because this person at $45,000, did I put $45,000? Yeah. $50,000. Same difference, right? I mean, you can see it. That we've given ourselves a 4% pay cut that we could have avoided entirely. So you can see the errors compound, which is there's the difference between here. That presumes that was even the best plan. Right? Now we've got, oh, well, I've had some incumbent plan from a long time ago, and I was hanging around here. I heard that silver was best for me. And this is not a recommendation for anybody, but let's just take a generic silver. Same carrier. First of all, you can see it. It doesn't exist at net 304. So this person made this error, and now he's paying $471 because he didn't go through this process, when what was actually available for Mr. Perfect, totally reasonable for him because he's perfect, right? Which is, since he's perfect, and now we've got every plan, you can see the degree of error. This is too much money. 267 times 12? He's given himself a 6% pay cut. 6% pay. This amount of money here. My point here. $3,200 in a year. Now think to yourself, for this person, what is the likelihood? Oh, well, I spent all my time and effort thinking about contributing to my 401k. It didn't make up $3,200. Didn't. Right? How much is this person's portfolio worth? 401k worth? So you can see what has ended up happening. is that the time devoted here is just weird to me. It's just weird. Weird is like wrongly allocated, right? Meaning we spend tons of time going, well, I should have bond fund 1 versus bond fund 2. That's a difference of what, 0.001? Maybe. It's like 0.1% times portfolio. There's your financial difference. This is like $100, $200. This is $3,200. And this is 100% certainty. This is befuddling to me. So you can see understanding here why I've spent and paused here. It's just another illustration. Same thing for Medicare IRMA, by the way. For people who are older, I would say that this is the key year, the key time period. You can be eligible for COBRA for a wide variety of reasons, right? I've retired. You could be laid off. Whatever. Doesn't matter. The year that you enter COBRA is critical for financial planning purposes. This should be the singular topic of an entire video. Absolutely should be the case. Because what ends up happening here is the following. Is during that year, you have a couple of things. First of all, this gets mishandled, right? This number here gets misunderstood. One year, this happened this past year. It's probably the worst case that I heard, which is person was wrongly told by HR that the retired person who is now Medicare eligible had to stay on COBRA in order for the wife to qualify. They were wrong like 3x here. And to give you an idea on how big it was, COBRA in their case was something like $1,500 a month. Medicare cost $175. They took it, which they may not have had to. Okay? And then to give you an idea, they would have been able to get health insurance at $500 for the spouse. They torched, right? Their total equals $1,650, $1,675. It should have been $500 plus in Atlanta, $130 for Medigap, $0 for Part D due to the fact that he was another version of Mr. Perfect. This version total should have been something like, and this is just off the top of my head, $705. These are not well-off people. IRMA did not matter because it was not a relevant tax bracket. The point is, these persons, for me, they lost $970 a month. For 8 months. Even that money was theirs. That money was theirs. But by underestimating how big this number can be, there's no metric, there's no way, even if they were Rumpelstiltskin and knew perfectly financial markets, they still don't leave this money on the table. You don't. especially bad is that what they end up doing is that they ended up this. What they ended up doing was going to do this. So it's actually even worse than what I've just said, because they bought Medigap at the wrong price. And they bought this Part D at the wrong price. And I'm not laughing just because I feel so bad for them, but the reality is that they did it to themselves. So actually they paid 18. Yeah, that's correct. So they paid about $18.75 a month. It was entirely reasonable to get to $705 a month. So I underestimated. I try not to crush them, right? But the candid reality is that they lost. This to me is losing. Overspending wildly is the same as losing, right? That's just another way of putting it. This is $9,000. This is not a household that has $9,000 to torch. Don't get me wrong. A person with $5 million, they have no interest in wasting $9,000. They don't. Right? In fact, the reason they have that much money is because they didn't overlook this type of detail. That's more likely. But what ends up happening here is that, as we can see over here, the mishandling of COBRA here can be a problem. That's not all bad, though. That's not all bad, because it also allows financial planning window. Because of the fact that the way that the Affordable Care Act works, and since this is month by month, that it can be the ideal time in order to have other tax efficient allocations for investment strategy purposes. What in the world does that mean? That means now all of a sudden the window's open. Roth IRA, for example. Very notably. Right now, Roth IRA now opens. Why? Because the money coming in is first in, first out. Meaning you can pull out the money that is contributed. If, for example, if you are contributing into. And the second thing is that money market mutual fund is now at 4.25%. So this can be a usable amount of money. It used to be 5 years ago, and of course decades. This wasn't a bit as big because for me, there is no alternative. TINA was a thing 3 years ago. It's not anymore, and the reason is that money market mutual funds are so much higher. Meaning you could have collected at 4.25%, pull the money out for cash. So, for example, if you were in the Roth IRA, right? In other words, well, I'm trying to avoid taxes. Yeah, but now your makeup percent that you're getting is at 4.25% a year. And if you needed access to money because of first in, first out, you can get out usable money. So this is not all negative. It does take work, right? It takes work to think through all of these moving parts. And it is during this year, specifically during the year that you are retiring. It also means that if you're retiring at the very first, let's say it's the 29th now, so that's a bit difficult. But let's just say you're retiring in March. That means you have this very, very valuable time here. prior to retirement. The months prior to you retiring should be full of thought and planning here because it has to do with the Affordable Care Act if you're Medicare, if you're not yet Medicare eligible. Early retirees, white collar buyout plan. This is absolutely you 100% of the time. That this set here is, and you can now see the numbers that I was talking. This number in here is huge. So it's big for the 45-year-old, right? 45-year-old. And oh yeah, by the way, this is not going away. And I will stop here with this final point prior to going to Medicare. And this is even true because gig economy and Gen Z are going to encounter this more. I don't have a problem with gig economy. I do not. People like in other generations say, well, in the good old days, we stayed at a company for 30 years. That was the past. That same employer offered lifetime pension. So we don't have the same structure of employment any longer. It can be entirely rational. If you're a home run hitter and you understand social media, etc., can you bounce around and not be working for an employer for 30 years? Well, pretty sure Charlie D'Amelio thinks she's chosen correctly. She'd be right. Charlie D'Amelio is the lady on that won Dancing with the Stars. A dancer, something, 20 odd million a year for like multiple years. Something like that was publicized. For TikTok. Okay, let's go to Medicare here. The other day I went on Frankie Boyer's show. Frankie, I showed you, where is it? You'll see over here that, yep, here she is here, that I have appeared on her show a number of times, both for our business and, the drive-in show and for longer episodes as well. That what I was talking about was the fact that inside of Medicare Advantage are added benefits. So here's your insider's information, which is that very few people actually use the health club benefit. Right? The silver sneakers, if you said over that it's 10%, you are like wildly over. Wild. Okay. But that said, many plans have enhanced benefits for a B. And I'm going to, as I've stated in the past, what happens here is that I can't get the price. You can come to me for vision insurance, health insurance, or dental, for example. Fine, no problem. I'm going to tell you that if you take a look at the way this works out, that the way that Medicare Advantage works out is superior to this diagram in the private market. The answer is yes, it is. Jay's a cheapskate. I'm counting dollars. Part of that is the premium. Of course it is. The point here is that you don't get to, you need to sign up. In advance. And that has a deadline. You don't get to call up in November to say, okay, I want this for 2 months because I'm going to have like 6 root canals in December. That does not work. Right? Because this is annual contract, you have to agree in advance. That day is generally not January 1st. You'll have to check with the plan. It can be worth it. Why? Because max benefit amount is higher. So back to this diagram here. Those enhanced amounts, right? The loss is lower because I can't find that price in the private market. And the amount that which you can get this profit part and the extent of it, the key thing to dental, why it should not be called insurance, why it's got money has a naming problem, there's one, right? Which is that the amount you can get on the profit side is higher, meaning the amount of benefits that you can collect is higher under Medicare Advantage Enhanced than it would be in under normal cases, and certainly if you sent me an email. All true. But time deadline. Let's go to these other two. Medigap can be checked. I very strongly encourage this for people. We go to our clients regularly that if you want us to check here on Medigap for you, that's fine, right? Medigap, what happens is the prices drift. If you're Mr. Perfect, you're 70, you're 69. Your mother or father is Mr. Perfect, 69 or 70 for people who are Gen X, for example. That'll be your parents. If they're Mr. or Miss Perfect and they have Medicare Supplement Medigap, it is likely that their prices can be $1,000 a year lower per person. Yes, very possible. Who isn't part of the crowd that I'm mentioning? Birthday rule. Anniversary rule. And then Massachusetts, Rhode Island, Connecticut, New York. This generally doesn't work for you. And the reason is, since these rules are too flexible, all the sellers know that too. All the sellers adjust in advance in a hyper-competitive world. So you already have the best price because everyone is watching each other all the time without fail. Which has been my point here under this article itself. Which is one of the points I said here. The price of solutions is known and hyper-competitive. 5% in price, ha ha ha, very funny. Try 1/10 of that with multiple sellers. I realize that, sometimes a topic you may not think that it applies directly to you. There's a principle where if I just cross out Medicare and change this to term life insurance, it exactly applies to you. 40-year-old Mr. Perfect, 40-year-old Miss Perfect, need 20-year term life insurance? I can find you a tie. Tie to the penny. I'm very sure of it. If I'm off by 10 cents a month. That's how competitive the professional market is. That's how closely nailed down. This is. Right? This is why I also tell people, right? The idea that we are going to outmaneuver and outthink game theory plus calculation power plus legal resource power, and you're going to outsmart these guys on a price. And oh yeah, by the way, 5 competitors in the neighborhood. This is very unlikely and very counterproductive of your time. We can nail down the price within 2 pennies and it's over. You getting access is different. This is why this is one of the reasons why do it yourself doesn't work, right? Because the ability for you to find it is not the same as the ability for professionals to find it. Okay. One negative that what you cannot do, you cannot change your Part D. You cannot change your Part D. And unfortunately, we have this case every year. And 2020, I stated throughout 2024, throughout the entire, I said 2025 is going to be a tough year. 2025 is going to be a tough year. And sure enough, we got it. It's not because I had a crystal ball. I promise you that. If I had a crystal ball, there's no need for me to have a channel. Right? And I'll pull down Maximize Your Medicare as a book, which is that it was just because of the mechanics of the way that the prices and the way the machine works is known here. I'm giving you insight here without giving you the nth details because absolutely nobody will either understand or want to listen to it. But the point is 2025 was inevitably going to be a difficult year. It was. Again, 1/3 of the sellers of Part D plans disappeared entirely. And not because they were forced out. They just stopped offering. For everybody, you can hear the common thread here that for your single tip is you're to see your doctors as soon as you possibly can. Because you're trying to get an assessment from them has something changed here? Any moving factor here? Because since these enrollment windows are in your favor and you can get a new assigned probability of requiring expensive health care costs, or maybe you got a diagnosis, okay, you're now Mr. Perfect, you're now Miss Perfect. The gate swings both ways. That also means then that you can optimize, get the most, right? Get the most, which is not only about the revenue side, right? Is not only about the revenue side. It has to do with then minimizing the loss, which is this should be cash flow, right? I just hijacked this little diagram from options, but it should just be cash flow out, cash flow in. It's always follow the cash flow. I'm going to, related to that has to do with insurance carriers. You know, the United Healthcare matter and some more. I could literally comment about the press every single episode and some observation. It just so happens that the United Healthcare situation has, further focused or laser focused on the matter. I'm going to show you this, that, this was the doctor saying that dealing with health insurance carriers only is worse. Okay. And I'm not going to dispute the individual cases of what the individual doctors have said. Right? I'm not going to dispute that. Remember, for all of the next comments I'm going to make here, remember, late father, medical doctor young Jay needed food. Okay, so it is not about. That said, I find this article unfortunate would be really the kindest thing I could say. Because what it's talking about is that the doctors are yes, and this is the aggravation of convincing insurance company to pay for their this, and the other, and this is. There are elements of truth here. I'm sure of it. I'm sure of it. And I joke with my dentist and other people who I know who are dentists. I'm like, you've won this because you don't have this process. Well, first of all, they don't like cooperating with insurance, right? So as a result, they don't have to deal with the administration of this. But this is also incredibly one-sided. Because while this is true, this is also true. And oh yeah, by the way, that are caring for patients in private Medicare plans. So what ends up happening is carriers are buying doctors' practices. What United Healthcare owns 10% of primary care physicians' practices in the United States. 1 out of 10. So for doctors to be complaining, they're complaining about who? They're complaining about the party that is giving them higher payments for lowering costs. That is because what is not widely publicized or widely known is the fact that it'll be here somewhere. We're going to get to that in a moment. But you can see that the doctors that the insurance companies are also accused of, and how insurance companies and doctors, right? In other words, they needed cooperation here. And who did they get it from? Right? They got it from someone. Doctors and hospitals. So in order to get these payments. So for them to be the ones complaining here is pretty odd. I would just simply say, I will continue to say it, that healthcare cost delivery is so complicated in the United States. You take one side, I'll take the other side. We just start debating. I'll get us to a stalemate. 8 hours, no problem. No problem. Because by that same token, doctors, the most recent debt ceiling debate, et cetera, government shutdown problem debate, right? Doctors are going to be taking a 2.8% pay cut in 2025. So while everyone's complaining about and oh yeah, by the way, on what does it cost? They're still your primary care physician is still minus $300,000 in educational debt. Absolutely. And back and forth it goes. My point being very complicated. All right, just a few minutes. I left this because very complicated here. So last time I discussed MicroStrategy. And a lot of what I said, came to come to light now, right? Which is, as I've mentioned in the past, that 96% assets in Bitcoin, et cetera, et cetera. Here's the question, right? This is the primary. So here what you have is you have the primary question here. Okay, and this 2.5 here is dependent on the price of MicroStrategy. And this is captivating the professional world, right? Which is now down. And you can see it here. Take on the advanced chart. This first chart doesn't show us anything. Let's just take a 5-day look. Yeah. The high here from then to here. You can see it. Down 10%. If we take a month, unfortunately, it doesn't show you how much further it is. Right? You can see what has happened. So it has skyrocketed, but you can see from here. We don't have a price here. Let's just see if we can shut off these comparisons. We have this. We've hit from 472 to 330, which is what, more than 25%, 30% has to do with this ratio, and on top of that, this very complicated people don't understand what a convertible bond is, right? Which I've explained here. And now you've got these. Now the actual professionals are here creating this complicated trading strategies. There are multiple, right? And there are twists of here. So I'm giving you the general principle about what they are doing, right? They are remaking minestrone soup into their individual ingredients, and then they're trying to extract the value out of the undervalued pinto bean. That is what they are ultimately doing. I pointed out this to just a select few, which is, yeah, you could do this. I just was thinking to myself, how do I show this to you as people that are not necessarily involved or understand actually what the professional world considers? Which is, let's say you had $100, 100 units. Could you just buy Bitcoin? Yeah. Instead, what some people can do is they can buy X dollars, X out of 100 into MicroStrategy, and then 100 minus X into cash, where you're getting. So you can see what ends up happening. If Bitcoin goes up or down by 10%, those are your results from 100, right? So up 10%, down 10%, fine. And let's say, for example, if you had done the alternative could have been this. And this is very, again, oversimplified, not financial advice, every other caveat. But this is example. So now what you can see here is that under this scenario, if you took alternative 2, what could you have? You could have just Bitcoin. This isn't LTC, is it? I was thinking about something else. Bitcoin, scenario 1, where Bitcoin just matches MicroStrategy, or scenario 2 within alternative 2, where MicroStrategy falls a lot more. So under that scenario 1, well, now you're at 108, and this one at 90. So you can see it, except for this one has cash. Right, so in other words, if Bitcoin's down at minus 60, this one you've lost 60%. This one you've lost not all of 50, and you have 50% in cash. So better under crash scenarios. So now you can see what people are doing is that they are looking through these combinations in order to calculate, estimate, not with the crystal ball, estimate what the end results will be under different scenarios. Oh, right. And oh yeah, by the way, does that mean that it's certainly going to do this with 100% certainty? No. Right? There's a reason that we've got multiple branches here. Everywhere here on this channel. Everywhere. There's things you don't control. As I was trying to explain the other day. Things you don't control. Randomness involved. And then financial markets on top. In other words, lots of different outcomes. Many, many. Oh, and which is why I shrug every time someone says, target price. Okay. The headwinds still exist. Overall, I tell you the headwinds would still exist. I have stated since coming back online after a couple month hiatus due to the craziness of Medicare season and etc. and traveling and this and that and the other. I have made, every time I've been talking about this and consistent with stocks for show, bonds for dough, this is an overhang here. This is the 10-year note, the 10-year interest rate, U.S. Treasury 10-year, notably higher. And by the way, your election rally has basically, not coincidentally, right, gone. It's gone. In its entirety, it's gone. Minus, because this is the NASDAQ, this is the more diversified version of all the industries. So if you can cherry pick the winners, you always win, right? That is indisputable, right? If you've always called heads or always called tails and called correctly, you win. You will win. The question is, can you systematically do so? The question is, when you're wrong, can you manage the sequence wrong of losing twice, 3 times in a row? That becomes the question, and that's why you have a diversified portfolio, because you cannot do those two. That would be my hypothesis for, a chapter that the paid subscribers to Jae's Corner will see in a couple of days. So, this still remains headwinds, as I've stated, and it does absolutely come back to where I said right here at the beginning, how much does it cost? Interest rates are simply, how much does money cost? What's the opportunity cost? Right? If you want to spend money on X, that's fine, but you could have made 4% in stone. So now the comparison of what you're doing with your money now is higher. Why? Because while the cost of borrowing is higher, that means the return to the lender is also higher. Right at our jo.substack.com, all the information, links, the websites there on the left-hand side. Be sure to like and subscribe to this video and hit the notification bell, please. That's important here so that you get told when I'm going on for broadcasts.